All right. Welcome back to the Mortgage People podcast. I'm Sean Humphreys. I am joined, as always, by my good friend Von Zawadzki, and we are here to react live to the Bank of Canada's policy rate decision. I know we've got thoughts. I'm personally thinking there's no rate cut. Von, you want to hit something? What are you thinking?
Yeah, I think that it's basically a coin toss, but I'm going to land on the side that we all want. I'll say rate cut 25 beeps, but that's it.
All right. Well, let's play the intro and let's see who's right. All right, so it is imminent at this point. We've got 1 minute to go before the rate cut. If you're logged on and you've got a prediction, put it in the comments. What do you think? 25-0, will they hike? Will they surprise everyone and hike the interest rates? And what we're seeing is about a 50% chance either way.
A rate hike. Wouldn't that be a kick in the nuts?
Yeah, I don't think I think it won't happen, but I think that we're starting to see some reason for maybe why they might consider a rate hike. And I've got some charts I want to show you later. Surprise you with all sorts of different charts on
Can't wait to see
what
those
might
charts.
happen. Yeah, exactly. So I'm personally saying no change. Vaughn, you're at a quarter.
Very timidly at a quarter. The data there's enough data there to say that taking a break from rate cuts. What are we, eight consecutive in a row, or?
Yeah. And so the announcement is up. The Bank of Canada holds the policy rate at 2.75. So no change. And so they will not cut rates for the 9th consecutive meeting. And I think when you say it like that, will they cut for a 9th consecutive meeting? That seems like a lot. What's your knee-jerk reaction to this news, Vaughn?
Well, we still haven't had that one rate cut where it falls off the edge of the cliff, as I predicted a long time ago. We still may be faced with that. I think that there's so much uncertainty. I think if you look at how the markets reacted, if you look at how businesses' hiring practice have paused, there's a lot of uncertainty with the stable genius, the big orange man south of the border, seemingly running his country based on the whim of his Twitter account. It's like prudent to not make any decisions, I think. And the Bank of Canada did come out after the last rate cut and say, look, we're not going to be forward thinking about this. We're not going to try to predict where the economy is going to be. We are going to be reactionary. We're going to make decisions based on current data and not perceived future data. And I think that this supports, what they told us 4 weeks ago.
Yeah. I just want to share I'm just going to get this teed up here, but I want to share the policy rate from the last, so Canada's 5-year government bond yield. I think this is pretty indicative of where we've been and what the rates are looking like right now. So this is really what the banks base, not the Bank of Canada, but the banks base their fixed rates on. And so although there's no change in variable rates, we have seen kind of, this is over the last 6 months, kind of a lot of support around this 3% range. And since February, we've been more and around the 2.7% range. So today we're down to 2.67. If we want to look at like the last, today, basically, not a lot of change, kind of in this 2.67 range. But I'm not expecting this news to change our fixed rates in any remarkable way right now. I think we're going to see kind of a continuing of this rate. Now, you might see lower rates at your bank. Maybe they have a promotion going on in the spring market, but I'm not expecting that we'll see a huge change with that.
Well, I mean, the fixed rates are still hovering around 4%, and they just kind of crept up a little bit over the last week and a half, 2 weeks. It looked like it was going to be like we're going to ease our way into a more productive spring market based on interest rates. But, that like everything else, is sort of taking a pause. Same with this Bank of Canada rate announcement. I mean, how is this going to affect the real estate market in the GTA? It's probably another 6 weeks of people sitting on their hands, like unless something else, some other big news happens that makes people feel that there's stability in the market. I mean, the real estate market right now is as stable as it can be. There's not a whole lot of price fluctuation. We're not seeing a ton of distressed sales driving values down. It's stable, but it's just not moving because people aren't investing in any
Yeah.
kind of capacity right now until we have a better idea of what the next 4 years is going to look like. At least that's my
Yeah, I think for
interpretation.
sure Donald Trump's trade war is giving us a huge heart attacks, and whether or not that's going to change or not, I think that's a big indication of what we'll see in the real estate market and in Canada's market. If we're looking at inflation, it decelerated in March. We were up at 2.6%. It came down to 2.3%. In terms of a high level look at inflation, I've got another chart I want to show you, but it did, and that's mainly due to the carbon tax coming off of gas. We're seeing, and then the GST holiday is also, you can also mix that in there. So we're seeing lower costs, but gas is volatile, right? We can see gas go up for some major world event. Gas could go up immediately, and that cost would be baked right back into our inflation details.
And we should also mention that in Canada, we calculate mortgage interest inflation in our overall inflation number, so that 2.3%. And I was reading an article that suggested that if you removed the mortgage interest inflation, which most countries don't have it in there, we'd be well below. We'd be like around 1.6% inflation, which would have signaled a rate cut today. So, when you look at it, you're like, well, some of the factors point to this, some of the factors point to that. I think that
Right.
we still have a ways to go. We're very close. Like, I think we're hovering, in my estimation, about in a safe place where people could feel comfortable investing in real estate, or like, and when I say investing in real estate, I mean buying a house to live in. I don't
Right.
mean as an investment exclusively. I do mean as a dwelling.
Well, I want to come back to that, Vaughn, but before we move off of inflation, I just wanted to share this. So this is the share of the inflation components that are growing over a 3% rate per year.
Break
And
that
so
down
if we
for me,
look,
buddy.
pardon
I
me?
said,
Yeah,
break that
so
down for me.
for sure. So our basket of goods of what we base inflation on is based on hundreds of different items. I think it's 140 different items, but I might have that number wrong. So the percentage of those components, those pieces of the economy that are growing over our 3% target, is now up over 40% of the basket is growing faster. And so if you just look at this as just in terms of a trend of inflation, you can see that we're bouncing back up. We bounced off the bottom where everything was growing slower than 3%, and now we're up over 40%. And really anything over that 35% threshold is, hey, let's sound the alarm. This is a bit of an issue right now. So that's why I'm saying I didn't think the Bank of Canada would be lowering interest rates today, because inflation is not under control. It's actually going the opposite direction that we want it to hit. So you can take out things like, gas is growing, it has come down in price. But if you look at the overall basket of things, it's
Sure.
it's accelerating. Inflation is getting worse.
Well, especially when we have this sort of trade war based on tariffs, which is automatically inflationary. It automatically drives the price of some of those, 140 items up. If we bring them in from the States, then it's 25% more. So, yeah,
Yeah.
I definitely see that. Even though it dropped 30 basis points year over
Yeah.
year, but I
Overall
can see.
inflation can go down for sure, but the individual pieces are floating up. And so I just think that the Bank of Canada shouldn't be lowering interest rates in this climate right now, especially when we may need to keep some of our powder dry for a prolonged tariff war. I just don't think that today was the meeting to do it. I got one
Yep.
more for you.
Oh,
So if you look
giddy up.
at this is for short-term 1-year U.S. inflation expectations as of today. So this is for March. That number is skyrocketed. It's like well above the expectations of where inflation was going to be going in even before COVID, during the COVID period where everybody expected things to be more expensive in the US. Now, this is a US number, but I think this is kind of indicative. We don't have this data here of where inflation is sort of heading, where people's minds are at. Do you like, if you, I would ask you, do you expect things to cost more next year? Of course, because of tariffs, because of everything else. So
That's terrifying.
it's terrifying, right?
Oh, that wasn't meant to be a pun, but I think it it works. It works. I mean, when you look at that, that's just, if you have any
Let me go
capital,
back to that.
that's just your money disappearing.
Yeah, things are going to be more expensive. Probably wages wouldn't keep up with. Now, that's not what inflation is, but that's what inflation people believe inflation to be, which is can be a self-fulfilling prophecy.
If you panic, for sure.
Yeah. If we look at Cora forward rates, so this is the shortest of short-term interest rates and where people believe interest rates are going. This is what the Bank of Canada would use, this is what the markets are thinking in terms of where interest rates are going. So this is as immediate of a metric as we can get. And this is what people who are betting millions and billions of dollars into the market, this is what their expectations are in terms of where the Bank of Canada's policy rate is going to go. They're saying 1 year out, we're only going to be 0.25% lower, and then we're going to be flat for the next 3 years.
I mean, it's almost like a drastic turnaround from where we were with predictions by the economists, like let's say 4 months ago, where everybody was fairly confident, other than, remember, Scotiabank, everybody was fairly confident that we would hit about 250,
Yeah.
225. I'm still saying 2%. I think the
Right.
fallout from this is going to be bad when if you have prolonged periods of no activity. You're going to have a dormant market that may take some time to wake up.
Yeah, and I think a lot of the banks are still predicting. So this isn't necessarily the economist predictions. Sherry Cooper's predicting another, who's our Dominion Lending Center's chief economist. She's predicting another 3 interest rate cuts by the end of 2025. So we'll get down to that, your 2% target that you're seeing. Royal Bank is at, I think they've revised up to 2.25%, but they're kind of all within that range. It's still another 2 to 3 interest rate cuts to go. But that's not what the market is saying. So the economists are predicting one thing, the market is predicting less interest rate cuts. So that being said, I think we're close to the bottom right now. I don't see, it's not like we're going to cut another 2% off of what, we started at 5 and we're at 2.75% now. We're not dropping another 2.25%.
No, there's nothing no indicators to predict that things will get that bleak. I mean, we want to cheer on low interest rates without cheering against our economy. And, I guess we'll see what a new government in Canada, because we're right on the precipice of that as well. What the new direction of the country will be. It seems like we've moved away from, socialist leader Justin Trudeau to more moderate leader of the Liberal Party, Mark Carney, seems to be more, economy focused, and certainly Pierre Poilievre and the Conservatives are pushing even harder for pro economy, which would, if we get that and the economy, sort of kicks up, then we're kind of where we are in terms of
I think, in terms of a political take on this, I think that we will, whoever is the next prime minister, and I think we've on here predicted that it's going to be Pierre Poilievre, is
The last
undoubtedly going to be the
time,
next prime minister. Probably the last time we met, that was the case. But today, it seems like it's going to be Mark Carney. He seems to resonate with more Canadians, but I think the flavor is very similar. Like, it's a much more business focused, building. Let's build pipelines. Let's build railways. Let's protect Canada. Let's invest in, and I don't know if this is anybody's platform, but invest in research and development. There's a huge group of scientists that are leaving the US. How can we maybe capture some of the best and the brightest and bring them to Canada? And how can that be a long-term benefit to us and to strengthen our economy?
Sure. I mean, I think that we need to have sort of a pro mining and natural resource focus for the next 10 years. That will be my guess in terms of turning this thing around and building Canada's maybe like a little bit more independent as well. I don't think that we need a massive knee-jerk reaction to what's going on politically right now. People say, oh, we shouldn't have trusted our neighbors in the US so much. I think that that's similarly, when in COVID, when we realized, oh, we don't manufacture pharmaceuticals here anymore, and it's like, do we need to panic and bring back manufacturing pharmaceuticals on a mass scale, like just to create a once in a 100-year vaccine? Like, no, I don't think that we need to go that far. I don't think that we need to go that far with thinking that Canada has to be on an island as well. I think we just have to get through the next 4 years. And things will settle down politically.
Yeah. We need to have, this goes for Canada, but it also goes for the US. We need to have reliable partners and be a reliable partner to our partners in around the world. And I think if you're looking at a reliable partner, Canada has all the ingredients to be that, whether it's in oil production or minerals, natural resources, energy. We are that stable economy that different countries can rely on. And I think that's ultimately where we will get to with this trade war, is that cooler heads will eventually prevail. I think it's just a matter of time. And we will start to see development here in Canada that benefits that. So when I'm saying let's build pipelines, let's build railways that support that, let's build out our ports around Canada to be that, I think let's just set ourselves up as that reliable trade partner.
Yeah, I think that's the type of investment that we need to be making. Handing out, millions of dollars to citizens isn't going to create that sort of job growth, that sort of economic prosperity. I think investing in that infrastructure, investing in those industries, that will get people to work, that will generate revenue.
Absolutely.
We can, hopefully we open up globally a little bit more than we have in terms of other trade partners. This could be a great opportunity coming out of a otherwise terrible situation with an unstable. Our biggest partner is now unstable for the next foreseeable 4 years. Could
but
produce a lot of good
I think that it becomes more stable within a year. I think that all of this calms down. I'm hoping all of this calms down for Canada, but I still think within the US it will be politically unstable. It won't be safe for research. If you're in science or research and development, or you're an immigrant to the US, that will continue to be that way for the next 4 years. And that is an opportunity for Canada to get some of the best and the brightest here into Canada, and helps propel us forward as a global superpower.
Yep. I think it's a great opportunity to pull up our socks as a country and shift our focus from post-COVID recovery and all of the super what would you call it, like social issues. I think it's nice to put that to bed now, and let's focus on some grown-up shit here and get the economy going, get people back to work, and move away from some of that rhetoric that really we don't need to be focused on.
Yeah. I wanted to point out one more thing here. I want to share another slide here. So I know we're talking, let's shift gears here, and this will be no segue. Um, so I want to take a look at the sales to new listings ratio, because I think that this is for the greater Toronto area. This is the number of sales that we've had versus the number of new listings that are coming to the market. And so what this indicates is like how fast is the market moving? How competitive is this market? And the 10-year average on this metric is 59%. During COVID, it was up over to like 70. We saw a big bump in 2017 where it was like 81%, where people were like day trading houses. It was nuts. Right now, we're down at 33%, meaning that the spring market is here for sellers, but buyers are not participating at this point. So the way I read this is that this is a great opportunity. If you're a buyer and you have some certainty in your life, you know that you're in a safe job, maybe you're unionized or a teacher or something like that. This is probably the most sophisticated and calm time it will be to buy a house in our lifetime, in my estimation. There
Yeah.
are lots of listings.
I think that there was a flurry of activity when we sort of just broke into the new year this year, because this uncertainty wasn't there, and I think that those people that purchased, in the last 3 months are going to be really, really happy. Short term, it could move slightly into a negative position, but ever so slightly, because prices have held steady. This is strictly based on what the demand is looking like. And I think it's just simply because of uncertainty of like, what will cost of goods be? What will my employment situation be? This isn't so much the FOMO driven conversation that we've had before of like, oh, what's my neighbor doing? I'm going to wait. It's much more impactful, if
Mhm.
people are actually worried about their employment. But I think that you're 100% right. If you're in a stable position, now you have time to shop, you have time to put a condition on the financing, you have time
Yeah.
to negotiate. In terms of what I think you said, calmness, a lot of people do not like the bidding war situation. I don't think that we have fear of jumping right back into that yet.
No.
Probably eventually, but you're right. Right now, nice, relaxing time. If you were interested in buying property for yourself, go out and take a look.
And this isn't just condos either. Like there's a ton of condos for sale in Toronto. If you're looking for a one bedroom condo, you've got your pick right now. But this is also in some detached. Some of these first time home buyer properties that we've seen typically just get gobbled up as soon as they hit the market. They're not sitting for weeks and weeks, but they're not getting 20 offers each. That might be having 2 or 3 serious offers come along,
For sure,
which
and
means
that
that
makes sense.
prices are not going to shoot up.
The numbers, definitely indicate that. If you think of the size of a loan, on a entry level property, you're still looking at like an $800,000 loan. And if there's any uncertainty about your employment or about the cost of living, you may be hesitant, naturally reluctant to take
Mhm.
on that $800,000 loan. So it does make sense that all property types at this point, with this economic situation, would be slower moving.
Yeah, and I think so. We hear a lot about, well, I'm going to wait for the market to go down. I'm going to wait to see what happens. If you're in a position where you're not trying to buy a house and flip it in a year, this is your golden hour right now, where property values are not going to, could they go down a little? Yeah, maybe. We could probably see some property prices fall. But if you're buying a property and you're going to live there for 5 or more years, this is the opportunity to get into the market. Where I'm not really there is some downside risk immediately, but in terms of the long play,
Yeah,
getting
I
into
do.
a
I
property
wouldn't.
now is the time.
I wouldn't worry about equity or housing. I definitely would not bet that the housing market will collapse or crash or whatever. Everybody who has made that prediction has been priced out of the market every single year for the last 15 years. So, if you
Mhm.
want to make that bet, go ahead and make that bet. Continue to live with parents or continue to rent. But you have house if you're not living with your parents, you have a housing cost anyway.
Yeah.
So it's really, if you have a down payment, do you want to watch it erode, or do you want to, put it to good use? I think that I would not be timid to buy in this market right now, but it does depend on your particular situation. If you think that your employment is steady, hey, it's a great time to go out and take a look. If you're worried about your employment, then yeah, be conservative. That makes sense, and the market reflects that, I think.
Yeah, I agree. But interest rates have come down. I didn't get that slide. Interest rates have come down. Wages continue to go up. Prices have come down and not gone back up. In terms of affordability, this is the best possible. This is as good as it has been in years.
Yeah, I think that we're in a pretty good spot in terms of interest rates. I think that we're 1% higher than like the sweet spot, and we're about 2% higher than where it becomes really sexy, right? cut
Tell
rates,
me about that.
cut rates 2%, and then you pull up that chart where the 2021, when we were like 71%. That
Yeah,
would push it back there. The interest rates would
right.
have it moving that quickly. But 1% from like, we're dancing, we're having a party. 2% from like it's going to be insane again. But right
Yeah,
now, it's like it's safe. I think that Bank of Canada holding rates right now tells you that, like, hey, I think this is probably, now I'm saying this is probably what we're going to get used to.
yeah. Just want to get one more prediction before we jump off here. In terms of a fixed versus variable discussion, what is what are you seeing? What are you recommending? I can go first if you'd like. Springing this on you here. What's your
Yeah,
call
what
on
do you
this?
tell me? I mean, I have thoughts on it, but let's start with ladies and
Okay.
gentlemen, John Humphreys.
So if you look at the projections of where the interest rates are going and what's going to cost you the least amount of money over a 5-year term, the variable rate mortgages is still the king and still would cost you the least amount of money. But the 3-year fixed and the 5-year fixed are not that far off. It's not a slam dunk on variables are clearly going to be the right choices. Maybe they were like a year ago or even less than that before they started cutting rates, where you might be locking into a 6% interest rate for 5 years versus locking into a variable at 6 years and knowing that the Bank of Canada was going to be reducing policy rates. Easy for us to say now because they reduced them 8 times. But still, there was a good projection that interest rates would go down. So what I'm saying to a lot of people is the 3 and the 5-year rate are pretty similar. And with all the uncertainty of the next 4 years with the Trump administration, I think that there's a good price to pay to go fixed right now and get off of the roller coaster. If you're getting a decent fixed rate, whether it's 3 years or even 5 years, knowing that the penalty to break a 5-year fixed rate mortgage is higher, I think that there's a lot of people that would consider locking into something and just regardless that it might cost you less, but there's a chance that it might cost you more right now and just not having to worry about what might happen.
Yeah, I think that's pretty good advice. To be honest, I think that I don't. There's not a huge case, I don't think, right now for variable. I mean, even based on my prediction that Bank of Canada gets down to 2%, it's only 75 basis points, right? So it's really, and I'll sound like a broken record, it's really going to depend on the discount off of the variable rate that you get. And right now, the
Sure.
discounts aren't great. If you're
No.
getting a prime minus 0.3 or something like that, what your whole gamble is the Bank of Canada is going to make up that spread for you, and I don't think that there's evidence to support that it will.
Yeah.
Even if you get down to 2%, and that seems to be the lowest prediction of anybody, including myself, then it's probably not going to be enough, and we do have the potential risk of Bank of Canada increasing rates if we do get into some kind of prolonged trade war and the cost of goods goes up. You're not getting a deal there. I think that
That's right.
I think that this is one of the true situations where you would need to talk to your people and how are they going to sleep best at night, and that's probably the best decision for them. Like plain
Definitely.
and simple. That's it.
Yeah. How will you think about it? Basically, what's going to be? How are you going to think about your money? Are you going to be worrying about what Donald Trump is going to put out on Truth Social again, or can you just get off the ride for the next 3
As
to
far
5
as I can
years?
see, there's not a clear-cut winner or loser with the fixed or the variable.
Yeah.
So it's like it in that case, it's like it's fairly safe to go with either one.
Yeah, I agree. Okay, well let's end it there. Thanks for joining me again. It's been a minute, and thanks for joining us on the Mortgage People podcast. And we'll see you next time.